Let us say that I have a friend who is 30 years old and he is investing for a period of 30 years till he retires when he is 60. Now he is investing 5,000 rupees every month, which gives him 12% per annum return or 12% interest every year for the next 30 years. Right? He starts at 30 years, he ends at 60 years. So he has an investment period of 30 years, investing 5,000 rupees every month, getting 12% interest per annum. Now I am starting, let's say when I am 40 years. I have only 20 years which I can invest in, 40 to 60, which is 20 years. I am investing the same 5,000 rupees, getting the same 12% interest. When I retire at 60 years, my corpus will have been 50 lakhs. I will get 50 lakhs. But the person, my friend who invested 10 years earlier when he was 30 years, he will end up with 1.75 crores. Please look at this difference. You can go and do this calculation and you will see it up on the screen, but this is a true calculation. 10 years earlier, you started 1.75 crores with the same amount. 10 years later, I end up only with 50 lakhs. So start early, because the power of compounding, as someone said, is the 8th wonder of the world. The earlier you start, the amount which you keep investing compounds. Compounding means adding interest to principal, and your new principal will become higher. And then when you add interest to that, your next principal will become higher. So your principal amount keeps increasing year after year. So use compounding, start investing early. Now you might ask me, where do I invest? Invest into a structured, organized method. Invest, I would strongly say, the younger you are, the more money you can put into the stock markets. People think the stock market is risky. That's wrong. Stock markets are volatile. It is not risky. So what you do is, don't put a lump sum of money into the stock market. Do something called a systematic investment plan. So every month, I can put as a small amount as 500 rupees. That is the minimum systematic investment plan which you can put in a mutual fund. So if you start putting 500 rupees in a mutual fund every month, you will be amazed that after 10-15 years, the kind of returns you have. You would have earned an amount of money which you can't imagine. Because when you invest 500 rupees every month into the stock markets, when the first 500 rupees will go when the Sensex or the index of the market is high. Next 500 rupees might go when it's lower. Then the next 500 rupees when it's slightly up. So what happens is your investment of 500 every month gives you an average price which is much lower. And when the market suddenly takes off, the stock market suddenly takes off, your earnings is much higher. So start early, do a systematic investment plan and do it into the stock market through a mutual fund. That is the first and most important thing you should do as a youngster. One thumb rule which is very well known in the investment arena or the investment field is this, that the amount of debt or safe investment which you have to make is equal to your age. So if you're 25 years old, you shouldn't have more than 25% of your investment into safe investments. You can take 75% and invest it into asset classes which are a little more risky. When I say little more risky, I'm not asking you to go and put it in chit funds, unorganized borrowing. Go put it into mutual funds. You can buy gold bonds. You can invest it into real estate. But invest it into something which is organized, which is tangible, which is protected by the government. So the earlier you start, the better, and you have to invest it in a systematic plan. Please remember, if you're 25, 25% has to be in safe instruments, 75 in risky. So as you grow older, let's say you go to 50 years old, then 50% should be in safe, another 50% can be in little riskier investments. When you get to 70% in safe instruments, 30% in risky investments. So that is a natural progression. But where do I invest? First investment as a youngster you make is in mutual funds. And do a systematic investment plan. Do not try and time the market, saying I'm going to invest now, the stock market is going to go up. You listen to a friend, your friend says, no, invest, the market will go up, and you invest, the market comes down. You can't blame your friend. He would have exited, but you have to invest in a systematic investment plan. That is very important. Now, the next kind of investment if we are talking about is we all like investing in gold. Because our families have invested, as Indians we like gold, spouses, we need it for our daughters, children, we like gold. But gold is an idle investment. You buy it and lock it up. So instead of gold, I strongly advise you to look at something called the sovereign gold bonds which the government is giving today. Where you get the value of gold, you get it at a discounted price, you also earn an interest of 2.5% on it every year. And when you want to redeem it, you redeem it and they will give you the value of that money of the gold at that time. You will get the value of the gold at that time. You can take that money and buy gold. So you don't lock your gold up for 6-7 years till your daughter gets married or you need it for some occasion. You buy a sovereign gold bond. So there are a number of different avenues of investments are coming in. Don't get greedy. Everyone is talking about bitcoins. A bitcoin went up from $1,000 to $17,000 and came back to $6,000, all within 6 months. And if you look at the last drop from $17,000 to $6,000, it's happened in a week's time. That is a greedy investor investing into that. You will only lose money. One of my friends asked me, shall I invest in Bitcoin? And he's in the US. I told him, boss, you'd rather go to Las Vegas than to buy a Bitcoin. It is so dangerous. Invest into instruments which have been there for years, which have given you historical returns. If you look at the overall investment scenario in our country, anyone who's invested in equity, over the last 50 years, statistics will show you that 1 year you might get very high, 1 year you might get very low. But the average return which you get is about 15%. You invest into real estate, the average return you get over a period of 25 to 50 years will be about 10 to 12%. The average return which you get in gold will be around the same rate, 10 to 11%. The average return you get out of a fixed deposit before tax is about 7.5%. So it's a no-brainer that you have to invest more into equity, maybe a little into gold and a little into real estate. That is called asset allocation. So as young people, please have a financial plan, please have an asset allocation and start investing early and invest into the organized sector. Remember, as you're younger, the more into riskier assets, less into non-riskier. When I say riskier, non-riskier, I'm not talking bitcoins, I'm talking about share, I'm talking about gold, I'm talking about real estate versus fixed deposits. That is the kind of explanation I'm giving you. So please be cautious before you invest. Please take a proper investment advisor's view or their suggestions before you invest. But please, investing is in your hands. You draw a financial plan, you draw up your goals, and then go and start investing. This will be an asset for life.